Hey, good morning. This is Driving Markets. I hope you're well. Okay, so let's start off from the top and let's see where we're at regarding financial markets. So yesterday, the markets were up and then they came down after the Labor Department in the US brought out its PPI. The PPI is the Producer Price Index. The Producer Price Index effectively is the manufacturing index of the states. So what it costs to produce the goods. Now, they were expecting a lower figure than what came out yesterday, and it came in at 11%, which is the highest year on year in nearly 40 years of inflation in the States. Remember, we're talking about the Producer Price Index, not the CPI. So that will feed through to prices in the street and to the consumer. On Wednesday, you had the Consumer Price Index, which was the actual price or the inflation measure that consumers pay within the USA. And yesterday came out the PPI. With that, the markets actually were trashed to such a degree that it looked like the Dow was going to fall below the 30,000 level and the Nasdaq was going to close below 11.5. And then in towards an hour before the close, the markets rallied and managed to erase all of those losses. And the Nasdaq actually finished slightly up. Now, technically, which I don't like to talk technically on this particular program, but technically, there is a graph that shows that we're due a rebound, and that's actually happened overnight. There's been a slight rebound, but we're due quite an aggressive rebound because at the moment the sellers have been in complete control of selling this market. It doesn't look like it's going to end soon. However, 1 day or 2 day trade, it looks like there could be a strong rebound in currencies, in indices, in shares, and in cryptos. So keep an eye on that. You've also got to look forward towards the rest of the year, and inflation is here to stay. It's an unfortunate characteristic of where we're at the moment, and it's here to stay. So there is going to be increased volatility over the next 6 months to 12 months. Now let's look at a couple of the equities. Let's see what's going on in the equity market. So Ford yesterday and General Motors were downgraded by Wells Fargo, and their shares dropped. You've got retail sales, or there's some of the Under Armour and Nike and Home Depot. They reported good, strong retail sales, which again, when there's strong retail sales, then obviously the retailers are going to increase in price, but that's also going to add further to inflation. So the main underlying factor characteristic is what impact it's going to have on inflation with all of these upbeat reports from some of the companies. And some of the companies that don't report well are being hammered. So the last couple of days I spoke about a company called Upstart. Upstart is a high-tech company in the Nasdaq. And what do? They have a digital lending platform based on artificial intelligence, and their shares simply were hammered. They lost over 78% within 2 days because they said that their forecast is horrendous. So therefore, those shares that don't reach up to analyst expectations, what's happening is the shares are hammered and they're trashed completely. And that's what's happened to someone like Upstart. There's another company called View. Now View, they make glazing in the States, glass, and they're also a Nasdaq component. They also dropped out of bed because they said that they've got a problem with their accounts and it looks like their business is not going to be successful, and their shares also dropped around about 70%. And that's just to give you an idea, an example of what happens in the market when these companies don't realize or match up to analyst expectations. You have to be aware that the Nasdaq high growth stocks and high tech have all got very high multiples, and therefore they're likely to fail when it comes to analyst expectations, and they're going to expect a further downturn. Looking at the foreign exchange market, you've got to look at euro dollar. Wow, the euro dollar is well below the 105 level. It's broken all support levels, and it's going to go to 1-on-1. It's going to go to parity. Now that's not an if, it's a when. It's a matter, in my opinion, of 2 weeks, 3 weeks, and you will see euro dollar at 1-on-1 with the dollar. Sorry, the euro at 1-on-1 with the US dollar, and it could even go below that. It's its lowest level in 20 years, simply because Christine Lagarde and the ECB are not interested in raising interest rates in Europe, and Europe could go into a significant recession where in the US interest rates are going to rise, and therefore as a pair the euro is going to continue being pushed downwards. So keep an eye on that. Let's go on to cryptos. There's been a huge saga going on in the markets with Luna and Stablecoin and Terra USA. These are stable coins that are supposed to be hedged to a currency or another stable asset, and therefore not to be as volatile as Bitcoin. And what happened was that is a fund or a hacker or an investor somehow managed to short stable coins or short Luna, and at the same time short Bitcoin, and managed to break the algorithm that was there to protect the actual Luna hedge against its currency, and Luna lost 98% of its value. Therefore that pulls away the whole basis of stablecoin and makes it very, very, very uncertain. So what happened is that Janet Yellen of the US Treasury decided, or mentioned yesterday, that they actually need some regulation within the cryptocurrency market to avoid this happening, because the whole basis and idea of stablecoin is to make it stable, and if it's unstable then it's got absolutely zero value. So Luna was trashed. Going on to Bitcoin, Bitcoin did drop to 27,500 yesterday intraday and then bounced back up. I do see Bitcoin go all the way down to 20,000 in the near future, so that is something that in my opinion we should be going short on. Regarding 10-year yield in the US Treasury, remember the 10-year yield or the US Treasury bond is considered a safe haven when there is times of volatility, uncertainness, and that's exactly what's happened in the last few days. The US Treasury has been sought after. Investors have run to it, bought the US Treasury, pushing the price up, and the yields have gone all the way down to 2.82. So we could be going through a very bullish period on US Treasuries as times become more uncertain, and therefore investors look to secure their investment, pull out of high risk stocks like cryptos, like the Nasdaq, like high growth, and start moving into the dollar, which they are, and moving into the 10-year Treasury and maybe even gold. This is May Valensky with Driving Markets. Have a good day.